Hello and welcome back to our fourth, I believe, um, Camtasia video series dealing with Chapter 10. And remember, Chapter 10 is all about standard costs and as well as variance. Sorry. So what we're going to do in this video is we're going to work through the problems in the study guide, right? You have to do exercise 10-1, 10-2, and 10-3. So if we look in your textbooks, on page 472, you notice that exercise 10-1 asks us to calculate direct material variance. And they give us a bunch of information about Bandar Industries Berhad of Malaysia manufactures sporting equipment. Apparently one of these companies makes, or one product the company makes are football helmets for the North American market. And these football helmets require a special plastic. So they tell us that during the quarter ending June 30th, the company manufactured 35,000 helmets. So right there, that's their actual output. They made 35,000 helmets. They told us that they did this by using 22,500 kilograms of plastic. Again, that is the actual quantity used. 22,500 kilograms of plastic. And they give us the cost of $171,000. Again, that's the actual cost. Then they go ahead and say, hey, according to the standard cost card, each helmet requires 0.6 kilograms of plastic at a cost of $8 per kilogram. So you're going to have to work with me here a little bit in the sense of adding some rows to the table here. I apologize, I didn't thought I had enough, but I did not. Okay, so the first thing we're going to do is click on the first one and just go ahead and add a row. If I can find it, bear with me here. Oh, there we go. Insert, add a row above, and just do that twice. I think that should be enough. Okay, so the first thing we want to do, question 1 asks, question 1 says, what is the standard quantity of kilograms of plastic, meaning SQ, that is allowed to make 35,000 helmets? So we're trying to figure out exactly what is the standard quantity of that input. Okay, so in order to figure out standard quantity, we take before we get there, remember what they're asking for. The standard of quantity is based on the actual output. How much material should we have used? Okay, so we know right off the bat that we made 35,000 helmets. That was our actual output. Okay, we need to multiply that by the standard kilogram of plastic per helmet, which is 0.06, and we end up with 21,000 kilograms of plastic. Okay, so again, to figure out number 1, to figure out what the SQ is, the standard quantity, I take the actual output and I multiply it by the standard quantity per unit, right? And that gives me the total. Okay, so let's look at the second one. Second one says, what is the standard material cost allowed to make 35,000 helmets? So right off the bat, we need to know what's the standard quantity in kilograms that's allowed, and what is the standard cost per kilogram. So if you see in the problem, they're basically telling you, hey, here's what you need to calculate. You need to calculate the standard quantity times the standard price. Okay, well that's easy. We can definitely do that because we know what the standard quantity is. We already figured that out in part 1. 21,000 times the standard price. Well, the problem tells us that the standard price is $8 per kilogram. So I'm going to say times $8. That equals $168,000. Okay? Now let's look at 3. 3 says, what is the material spending variance? Now, right off the bat, we know that the material spending variance is the difference between the actual cost incurred and the standard cost allowed, right? So the material spending variance, and I'm just going to abbreviate and say MSV, equals price variance, or materials price variance, plus materials quantity variance. Okay, so we know we know right off the bat that the actual cost incurred to make these helmets was $171,000. Okay, so I'm going to rearrange this just a little bit. We know the actual total cost, which was given to us, right? It was $171,000. We're going to subtract the standard cost that is allowed. Okay, so minus standard cost allowed, which we just figured that out. We just figured that out as being $168,000. And again, it really helps if you can spell and pay attention to what you're writing. So the standard cost allowed, we just figured out in number 2, is $168,000. So that means that there is a difference in the material spending variance of $3,000. Is it favorable or unfavorable? Well, we actually spent $171,000. We should have spent $168,000. We are unfavorable, so I'm going to put a U there. Okay, so to figure out the material spending variance, that's the difference between actual cost and standard cost. Okay, so that's how we figure out the material spending, not PV, for variance. Okay, now we're going to go ahead and break this down into price variance and quantity variance. So this 3,000 that we're unfavorable, where does it come from? Does it come from price, or does it come from quantity, or does it come from a combination of the two? Let me show you what I mean. So if you click right here in our middle square, right off the bat, we need to calculate what the actual quantity is at the actual price. Okay, technically we could break it down and say, okay, here's the standard quantity, what's the standard price per unit, multiplying, whatever. We don't have to do none of that. Okay, they tell us in the problem that we paid $171,000 was the actual quantity at the actual price. Okay. The next thing we need to figure out is what is the actual quantity at the standard price. Sorry. Actual quantity at the standard price. Well, we know that the actual quantity used, the problem tells us, is $22,500. And I apologize, do me one favor. Add a row above this, and then we're going to move these numbers up. $171,000, and we're going to get rid of this 2,500 down here. Okay, so the actual quantity is 22,500 at the standard price, and we know from the problem the standard price is $8. Okay, if we multiply these two, we end up with a price that we should have paid based on the quality, or based on the quantity, of $180,000. We're going to compare that to our $171,000. I'm just going to bring it down. Okay, so are we favorable or unfavorable? We should have paid $180,000. We actually paid $171,000 or $171,000. We are favorable. The difference between those two numbers, let's center this here, is $9,000. Oh, sorry, $9,000 favorable. Okay, great. But wait a minute. In total, the spending variance is $3,000 unfavorable. Our materials quantity variance is probably messed up. So let's go ahead and calculate what the materials quantity variance is. Okay, so right off the bat we need to figure out what is the standard quantity allowed at the standard price. So we're going to say standard quantity at standard price. I already know what my standard price is. It's $8. I do not know yet what my standard quantity is. But if you think about it, I already figured out my standard quantity in number one. Right? I said the actual output times the standard quantity per unit tells me in total what my standard quantity is. Okay? So that's actually going to be 21,000 times my $8 standard cost. If I multiply those, I end up getting $168,000. Here's the problem. Based on the standard price, we're looking at the quantity, the difference in the quantity. I actually spent, or let me rephrase that, I actually used 22,500. I should have used 2,100. When I figure that out in terms of dollars, I see that actually there's a difference of $12,000. Am I favorable or unfavorable? Well, I'm unfavorable, right? How do you know you're unfavorable? Well, based on the actual quantity, based on the standard price, the actual quantity cost was $180,000. However, based on the standard price, the standard quantity that I should have used should have cost $168,000. So I'm unfavorable. The spending variance is the difference between these two, the $9,000 favorable and the $12,000 unfavorable. So there's where I get my $3,000 U, unfavorable. Okay? So right off the bat, I can talk to the production manager and say, hey, you messed up. The purchasing manager had nothing to do with it. They had a favorable advantage, or they had a favorable variance, favorable price variance of 9,000. We kind of, it started to go off the rails here when we looked at the quantity of material that we used. Why? Well, I had some the material that they bought was not good. They bought inferior product. That's why they got a good price. I got to use more quantity because I got to remake stuff and throw stuff away. There's a lot of waste. So might be one side of the argument. Okay. Now let's look at 2. 2 is virtually the same thing. What do you mean by that? Well, if you look at number 2, or exercise 10-2 on page 473, you notice that we have to calculate direct labor variance. Guess what? We're doing the same exact thing. Same exact thing, just using some different words, right? So before we do that, if you could do me a huge favor and go to the top one, and I want you to insert 2 rows. So do 1, do 2. All right. Okay. So number 1. Well, it usually helps if you read the problem before you try and do number 1, right? So they tell us that Sky Chef Incorporated prepares in-flight meals for a number of major airlines. This is like deja vu. Didn't we do another problem with Sky Chef Incorporated? Anywho, okay, one of the company's products is grilled salmon in dill sauce with baby new potatoes and spring veggies. During the most recent week, the company prepared 4,000 meals, so that's their actual output, using 960 direct labor hours. Again, that's the actual labors used, or actual labor hours used, excuse me. The company paid its direct labor workers a total of $19,200 for this work. Ends up being $20 an hour. Okay? According to the standard cost card for this meal, it should require 0.25 direct labor hours at a cost of $19.75. So right off the bat, we know there is going to be a rate difference. They broke it down for us and said, hey, actually we ended up paying them $20 an hour. Should have been $19.75 an hour. So right off the bat, we know we're going to be unfavorable 25 cents times some quantity, right? We know that. The efficiency variance, well, we can't tell that. We really can't tell anything out yet without multiplying some numbers, right? So question number 1 asks, what is the standard labor hours allowed to prepare 4,000 meals? So right off the bat, we are calculating standard hours, right? Guess what? We calculate standard hours the same exact way we did for standard quantity of material, right? Same exact way. We take the actual output. We take the actual output times the standard hour per unit or per meal. Okay, well, that's easy. That is just easy peasy for us because we know that the actual output was 4,000 meals. We know that. Times the standard hour per unit is 0.25. So that means that the standard hours we should have used was 1,000 hours. Okay, we can do that. We're good, right? So let's look at number 2. Number 2 says what is the standard labor cost allowed to prepare 4,000 meals? So in the problem, they tell us, hey, we want you to calculate the standard hours at the standard rate. Okay, not a problem. Guess what? We're doing the same thing we did up here in problem number 1. We're taking the standard hour, which we know the standard hours we just figured out are 1,000. And now we're going to multiply that by the standard direct labor rate, which the standard is $19.75. That ends up equaling 19,000, hard math here, $19,750. So we have the actual cost and we have the standard cost. Or wait, nope, not yet, sorry. Not yet, I apologize. Number 3 says, what is the labor spending variance? So the labor spending variance equals the actual costs minus the standard cost. Well, that's easy. The problem tells us that the actual costs for this meal were $19,200. The standard costs were $19,750. So right off the bat, we already identified we have a variance, right? 25 cents times some quantity, right? So we have our total costs here. We have the actual versus the standard. There's a difference of $550. Is it favorable or unfavorable? Well, the actual costs are less than what the standard is, so we are favorable. Okay? Now, if you can do me a favor, go down to this one row that has 3 in it, and I want you to add, and again, I apologize, 2 more rows above. So there's 1 and there's 2. Okay, so now number 4, they want us to, what's the labor rate variance and the labor efficiency variance? Easy peasy lemon squeezy, right? Super duper easy. We know we need the actual hours at the actual rate. Okay, well, what are the actual hours times the actual rate? Well, they give us the number. They tell us, hey, the actual direct labor hours that we used were $960. Oh, by the way, our actual rate ended up being $20 per hour. Okay, so if we multiply those, that's the $19,200. That's the same actual cost that we got in part 3. Okay, so in essence, we didn't need to do this. We could have just plugged in our $19,020, but it's nice to see where that number came from, right? Okay, so let's work on, for lack of a better term, equation 2, right? We need the actual hours at the standard rate. Okay, the actual hours that we use, they already told us it's 960. 960 hours times $19.75, because that's the standard rate. When we multiply those, we get 18,960. Okay, so are we favorable or are we unfavorable? Well, right off the bat, we can tell that we are unfavorable. We know that. We can just look at the rates. We actually paid 20, should have paid 19.75. There's a difference of 25 cents. 25 cents times some quantity, right? Which would be 960. So if we subtract or take the difference between these two, we see that the difference is $240, and that is unfavorable. Okay, so now we want to look at labor efficiency variance. How do I calculate labor efficiency variance? Well, I got to look at the difference between the actual hours at the standard rate and the standard hours at the standard rate. Okay, that's easy. So what are the standard hours? Well, the standard hours we already figured out in part 1, or item number 1 in this problem. It's 1,000 hours. The standard rate is $19.75. So easy math, we get 19,750. So right off the bat, we can see that we used less hours than we actually should have, right? We used 40 less hours. So 40 hours times the 1975 gives us 790. Or, working with the chart that we have here, we just take the difference between the 1890 or 18,960 and 19,750. We end up with $790. Favorable. So that spending variance of 550 is proven right here. For price variance, or labor, for labor rate variance, we were unfavorable, $240, but our labor efficiency variance is favorable by 790. The difference between those two gives us our 550 favorable. Okay, so if we look at this, we can analyze it and say, well, what happened? Well, the person did good on the hours. The manager did good using less hours than he should have, but we paid more than we should have. Why? Well, maybe we used higher labor, right? Maybe because we didn't use the hours that we should have. Maybe we had less workers and we used less workers, so we had to pay them overtime, but yet they were still able to get it done in a less time. That could be one possibility. Or he used, or she, the production manager, or the production chef, I should say, used higher skilled employees to make these meals, and they pay them a higher rate. That could be another option. Okay, now I know in the video, the lecture video, I just kind of said, hey, labor variable overhead variance. Look at direct labor, do the same thing. Well, we're going to do that. Okay, so, and again, I apologize. Select the first row, add 2 for me, a row above, and do it again, row above, and then we're going to come down here where there's 3, and we're going to add 2 more as well, a row above, and another row above. Okay, so guess what? We're doing the same exact thing we did in part 1, or exercise 10-1. We're doing the same thing we did in exercise 10-2. Same exact calculations. In fact, for the variable overhead variance, we use the same numbers. Okay, so let's work through that. So number 1 says, well, again, probably should read it. Logistics Solution provides order fulfillment services for .com merchants. Company maintains a warehouse that stocks items carried by its .com clients. When a client receives an order from a customer, the order is forwarded to Logistics Solution, which pulls the item from storage, packs it, ships it to the customer. The company uses a predetermined variable overhead rate based on direct labor hours. Okay? In the most recent months, 120,000 items were shipped to a customer using 2,300 direct labor hours. The company incurred a total of 7,360 in variable overhead costs. Okay? Now we get to the standards. What are the standards? Company standard says 0.02 direct labor hours are required to fulfill an order for one item, and the variable overhead rate is $3.25 per direct labor. Okay? Number one says, what's the standard labor hours allowed? So number one wants us to calculate SH, right? What is our standard hours? Well, that's easy. Again, we take the actual output. Oh man, I forget. I gotta multiply by something. Oh man. Well, what do we do when it comes to labor rate variance? Well, I do the same thing I did in, what do I do for variable overhead variance? I do the same thing that I did in direct materials in direct labor, right? I take the actual output times that standard hour per unit. Okay, so the actual output times the standard standard hour per per unit. Okay, all right, well that's easy. Well, they tell me, hey, you shipped 120,000 items. So I'm going to take 120,000 and I'm going to multiply that by my 0.02. That's the standard of how much time it should take. That ends up being 2,400. So my standard hours right here are 2,400. Okay. Number two says, hey, what is the standard labor cost allowed, right? So what's my standard cost? Well, that's pretty easy for me to do, right? What's the standard variable overhead cost that's allowed? They want they want us to figure out what is the standard hour at the standard rate. Well, that's easy. We can figure that out. We can figure that out no problem. We know that the standard quantity of labor hours allowed is 2,400. That's what we figured out in number one. We're going to multiply that by the standard variable overhead cost per hour. Well, what's that cost? Well, the standard says it's $3.25. That ends up equaling $7,800. Okay, cool. What are we going to do number three? Number three wants us to compare the variable overhead spending variance, right? So I'm going to say VOSV. And again, that variable overhead spending variance, it's a number. That number is made up by the variable overhead rate variance and the variable overhead efficiency variance. So we're trying to figure out what is that total number. It's just like what we did in the flex budget, right? The flex budget says, hey, you're favorable or unfavorable, a total of X amount. Okay, well, X amount is made up of the rate variance and the efficiency variance, or the price variance and the the price variance or the quantity variance. Okay, so they tell us in the problem, oh, by the way, your actual we're going to take actual cost minus your standard cost. Okay, well, we know the actual costs here are $7,360 360. We know, oh, again, helps if you can type, 7,360, that's given in the problem, minus, well, what's the standard, what's the standard, right? The standard hours at the standard rate. Well, we just figured that out in part 2 of this problem. That's the 7,800. So we have a difference right off the bat of 440. Are we favorable or unfavorable? Well, again, the actual costs are less than the standard costs, so we're favorable, okay? So now, number 4 says, hey, figure out your labor rate variance and labor efficiency variance, okay? So to figure out the variable overhead rate variance, I gotta figure out what is the actual hours at the actual rate, and I gotta subtract that from the actual hours at the standard rate. Very easy to do. They tell us in the problem, where are we here? The actual direct labor hours is $2,300. Oh, sorry. So I'm gonna say actual rate at actual hours at actual rate, sorry. And I'm going to compare that with the actual hours at the standard rate. Okay? So we already know right off the bat the actual hours incurred is 2,300 or 2,300. What's the actual rate? Well, they don't tell us what the actual rate is. We have to figure that out. How do I figure that out? Well, that's easy. I take my total cost, which they already give us as being $7,360, and I divide that by the actual hours, which is the 2,300 hours. So in the parentheses here, that ends up actually being $3.20. Actually, let me do it this way. Actually, no. I'm sorry, I'm trying to make this look a little bit more aesthetically pleasing, and I want you guys to figure out how I got this number, the 320. And again, I got that by dividing total cost by the actual hours. That's how I got the 320. Okay, so if we multiply this out, 2,300 times $3.20, we end up getting, again, a bit redundant, 7,360. But I just wanted you to see how these numbers are related, okay, and how the calculations are done, right? Because if they didn't, or they gave us the 320, we really didn't need to do this calculation. We know the total cost is 7,360, but again, that's how you calculate it, just in case you would ever need to. Okay, so moving on, actual hours at the standard rate. Well, that's easy. We know the actual hours is 2,300 times, we know that the standard rate, which they give us in the problem, is $3.25. So that means that we have actual hours at the standard rate should be 7,475. Okay, so looking at keeping the hours constant, we're looking at the difference in the rate. So right off the bat, we know we're favorable. How do you know you're favorable? Well, we actually used 320. We should have used 3 1/4 or $3.25. Okay, So I can take that 5 cents and multiply it by 2,300 hours, and that gives me my answer. Or I can do it this way and say, okay, let me just take the difference between actual hours at standard rate and actual hours at the actual rate, and I end up with a difference of $115 favorable. To figure out my my overhead, scratch that, variable overhead efficiency variance, I need to figure out what is my standard hours at my standard rate. Okay, so right off the bat, we have no idea what our standard hours are. Okay, but we have enough information to know that the standard quantity should be 2,400, right? We know that because we already did it in part 1, right? We took the 120,000 actual output times the standard. So the total here should be the 2,400 at the standard rate. Well, what's the standard rate? Standard rate's still the $3.25, which ends up giving me my 7,800. Okay, so if we compare these two, and again we're keeping the rates the same and we're just looking at the hours, right? The actual hours versus the standard hours. Well, if I take the difference between the hours, which is 100, multiply it by 325, well, that's easy math, I get $325 favorable. But I'm not too keen with those equations. I like looking at the chart and seeing everything visually in front of me. So I'm going to take the difference between the actual hours at the standard rate and the standard hours at the standard rate, which ends up giving me a difference, 325. I am favorable. So if I add 115 favorable to 325 favorable, that adds up to my answer for number 3. Okay, and that, my friends, is a study guide. You have enough now to get through the Connect homework. If this is as clear as mud, I get it. There's a lot here. Text me. We'll set up a session. We'll do like a little study session. I'll help you with your homework or help you with the problems, and we'll go through there, or we'll go from there. Okay. Good luck. I know we're behind on an exam. I will get that up for you tomorrow. You will have plenty of time to get it done. I will also do a little review video, give you a heads up. Here's what you should know. Here's what you focus on this, focus on that. When you study, you'll be fine. I promise. Again, if you have any questions, please feel free to text me. One student, and I don't mean to put her on blast, has texted me a couple times. And I'm more than happy to help out. I can't remember if I said this in the beginning of the course or not. I always have one student that's afraid of accounting and afraid of numbers, and literally every semester I always have 1 or 2 students that I talk to weekly. I don't care. I want you guys to learn something. Hopefully it's enjoyable, or as enjoyable as numbers can be. But if you're not getting it, I'm here for you. You just got to text me and say, when you available, I got to talk to you. Not a problem. We'll set up a time. I'll answer all your questions. We'll go through some homework problems, whatever. You just got to let me know. All right, so other than that, good luck this week. If you need anything, like I said, I'm only a text away. So have a great week, and we'll talk to you soon.